In today's video in the base school, we'll be simplifying IAS 38, Intangible Assets. We'll break down what they are, how to treat and measure them, and what to do with research and development costs, all under 4 minutes. Let's go! Intangible assets are non-physical assets that still have real economic value. Think of things like patents, trademarks, software, licenses, copyrights, brand name, such like the base solution. They're not something you can hold in your hand, but they add serious value to a business. To count as an intangible asset under IAS 38, the item has to be identifiable, under the business's control, and expected to bring future economic benefits. Plus, its cost must be reliably measurable. If any of these are missing, it's not going on the books as an intangible. Initially, intangible assets are recorded at cost. Afterwards, you can either use the cost model, where you subtract amortization and any impairment loss, or the revaluation model, which updates the asset to its fair market value. What is fair value? IFRS says fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Let's just say, it is the price you would get for selling an asset or pay to transfer a liability in a fair, normal transaction today. It reflects what willing buyers and sellers would agree on at the current date. Note: in measuring your asset, just make sure you are consistent. Like depreciation for tangible assets, amortization spreads the cost of an intangible asset over its useful life. It usually goes into the profit or loss statement as an expense. But if the asset has an indefinite useful life, like some trademarks, you don't amortize, just test for impairment. Here's the tricky part: research versus development. Costs during the research phase are always expensed because there's no guarantee it'll lead to anything useful. But in the development phase, if 6 key conditions are met, like feasibility, intention to finish, ability to sell, and reliable cost tracking, then you can capitalize those costs as intangible assets. Intangible assets are presented in the Statement of Financial Position under non-current assets. You'll need to disclose key info, like the useful life, amortization method, any revaluations or impairments, and whether the asset was developed internally or purchased. In summary, intangible assets may be invisible, but they're valuable. Start with cost, use amortization, and always understand the rules around research and development. Disclose what's needed, and you're IAS 38 compliant. That's IAS 38, simplified, because accounting should make sense for everyone, and in 3 minutes.